I'm about as bullish on gold and gold stocks as I possibly could be. And so when does that end? That ends, of course, when there's less automatic money going into the stock market. And that ends when unemployment starts to go up.
Hey guys, so today we have Adrian Day, and I'm very excited because today we will discuss the state of the current economy. We'll talk about the recent economic numbers, commodities, gold, silver, portfolio structure, and a lot of other very interesting topics. So Adrian, thank you so much for being here.
Well, thank you for asking me. It's the first time we've done it, so I'm looking forward to it.
Thank you very much, Adrian. So I would like to begin by talking about the economy. So we recently got the economic numbers, the data, the employment data. So what's your view, Adrian, on what's going on right now with the economy?
Are we talking specifically about the US economy at this point?
Sure. Well, I suppose everything's connected, but yes, we can
Sure.
focus.
Well, we'll start with the US. I mean, I think the US economy is and has been a lot weaker than the headlines would suggest. But most importantly of all, it's a bifurcated economy where the bottom, 30, 40, 50% in terms of income and net assets have been doing pretty poorly. And most of when you look at GDP, for example, it's an aggregate number. And so if the top 10% is doing extraordinarily well, that can distort the look of the number. And I think that's what we've been seeing. So when you look at things like consumer spending, for example, yes, the consumer spending is still going up. But when you look a little bit deeper, you find that discretionary items have really dropped off a cliff. And you also find that credit card balances have moved up tremendously. And perhaps now, more importantly, in the last 6 months, we're beginning to see credit card defaults and write-offs from the companies. So that to me, would suggest that some people are having a really hard time, even if the aggregate consumer spending is still moving up. Another really good example, of course, is the labor market. Jerome Powell, the Fed chairman, has a bit of egg on his face after saying just last week that the labor market was solid, and it's been clear to me for several months that that's just not the case. First of all, you've got those huge revisions first and second months. They publish it, the Bureau of Labor Statistics publishes a number, and then next month they revise it, and then there's a second revision 2 months later. And we've been seeing huge revisions in the numbers, mostly downwards. You're also seeing a big difference between the private sector ADP numbers and the government numbers, Bureau of Labor Statistics. And I'm not suggesting that the BLS is deliberately faking the numbers for political reasons, but clearly there's something wrong with the methodology. They use a different methodology than the ADP. And clearly there's something going on to account for those huge distortions. And then just lastly, if I may, on this, I mean, there's a lot we could say about the labor market, but the last thing to say about it is that if you look over the last 12 months, the majority, and I mean literally the majority of new jobs created have been either part-time or government. When you ask the part-time people, a vast majority, somewhere like 75% to 80%, said they wanted a full-time job, but only took a part-time job because they couldn't find it. So in the June numbers that have just been revised only once, the Bureau of Labor Statistics announced a grand total of 3,000 private sector jobs. Well, that's sort of meaningless in an economy the size of the US. So anyway, long story short, I think the economy in the US is weaker than the headlines suggest. and particularly weaker for the lower half. Now, let me just say something. This is not something that started on January 17th when Trump came into office. This is something that has been true, that the economy has, these numbers, the consumer and the labor have been deteriorating for a year now. One could argue, one could think maybe, well, anyway, I'll leave the politics out of it, but it's something that's been going on for a while. So that's the US, and also inflation, as we commonly think of inflation, which is price increases. That's of course not inflation. That's a result of inflation. But I think I would say that's not under control. So you've got numbers that are above the Fed's own arbitrary 2% target, which is a really perverse target when your mandate is stable prices. Well, 2% depreciation every year compounded is not stable prices. And it's also above the consumer price index level that we had prior to COVID. So even though it's come down an awful lot since the COVID highs, one would expect that just in the normal course of events. So inflation is not under control. I'm not one of those that's expecting it to run away anytime soon. But clearly it's going in the wrong direction in the last 6 months.
Yes, and so for the US dollar, Adrian, it's been really, really weak recently compared to other currencies, of course. So what's your take on that?
Yeah, well, this year, of course, in the first half, it was down something like 11% on a trade-weighted basis, which doesn't sound an awful lot to people who are in, junior gold stocks or emerging market stocks or anything else. But 11% for a currency is a significant number. And in fact, it's the largest first half decline in the US dollar since 1973. So that, just to put it in context, it's a huge decline. I think what we've seen happening this year is, now I have to get into politics, I'm sorry. I think what we've seen this year is implicitly and explicitly, the Trump administration has sort of made it clear that they don't really care about where the dollar goes. Now, they want inward investment, which, other things being equal, means the dollar goes up. Certainly inward direct investment, less concerned about the stock market. And so when you send a message to people that we don't really care whether we have your money coming in or not, and this follows a 15-year period when the US stock market has outperformed global markets, that's unprecedented. That's unprecedented since I've been following global markets. I mean, you get periods when the US is the best performer, but then you get periods when it's Japan or it's Switzerland, but to have the US outperform consistently year after year and by fairly wide margins, the non-US market. So people have reasonably significant profits in the US, and now they're being told on top of that we don't really care if your money's here. And so I think people are there's been some selling of US assets, frankly, that accounts for that.
And just in relation to the stock market, Adrian, so it looks like the retail are trying to use every single opportunity to buy the dip. They're looking for the positive news. They're not paying attention to the negative news to as much as maybe they should have. So what's your view on the current valuations of the stock market and where you believe it could be going?
Yeah, well, first of all, I'm a value investor. I'm a long-term value investor. So valuations are very important to me. I mean, the US market is, by many measures, by many metrics, is at its highest valuation ever. And nobody is saying that it's undervalued relative to its historic norms. That's the first thing. Then you look at other metrics like the breadth of the market. the breadth of the market is just not good. It's not as bad now as it was on December 31st, when it was again, the narrowest breadth in history. But everybody knows about the Magnificent Seven, and the Magnificent Seven are driving the stock market. That Magnificent Seven now accounts for almost 20% of the world's stock market capitalization, Now, you look at a company like NVIDIA. I don't pretend to be an expert on chips, and maybe this is just a great company, but it cannot have the same growth in the next 5 years that it's had in the last 5 years. It simply cannot, because if it did, it would in fact be 99% of the world's market capitalization. So you've got overvaluations, narrow breadth, and the other very important indicator is the ratio of insider buying to selling is at extreme levels on the sell side. Now, insiders can sell for a lot of reasons, all right? Remember, they're working for a company, and they also, in many cases, have most of their net worth tied up in that company. So I give a lot of people in those circumstances a pass if they want to take some money off the table. And it could be for something. It could be, an emergency at home, or it could be a lot of things. But even if it's not, I'm not a financial planner, but if I were, I would say to somebody, you're working for the company, you've got 90% of your net worth tied up with the company, you need to diversify. They get a lot of, depending on the company, they'll get a lot of cheap or free shares, they'll get a lot of low-priced options, and often what you see is when they exercise options, they sell enough of their shares to exercise the options and to pay the tax bill. So there's a lot of reasons that people can sell. Now, when people buy in the market, there's only one legitimate reason that you buy in the market. I'm not talking about people trying to pump their stock price up. There's only one legitimate reason, and that is you like the company and its prospects, and you think the stock is going to go higher. So when you look at the ratio of buys to sells, and you see it at extremes on the sell side, that's also not a positive sign. So I look at those indicators and I say, and there's many others as well we could look at, but the US stock market is just very, very overvalued. Now, from a value point of view, from a value investor point of view, when you say the market is overvalued, I'm not saying, but I think it's going to crash. I'm not saying, and I'm certainly not saying I think it's going to crash next week. All of that, because what I just said today was true 6 months ago and a year ago. What you're saying is that the risk in the market has gone up. And so as an investor, we shouldn't be making predictions. I'm going to buy X because I think it's going up. We should be looking at the risk and reward and the probabilities. And when the risk and reward is in our favor, that's when we should be buying. We're not making predictions. So I'm not making a prediction on the stock market. I'm just saying that I just don't think the risk reward is at all in our favor. And of course, we've been told many times, Warren Buffett has said it, Jerome, I forget his name now. The guy started GMO. What? No, the investor that started GMO. He's an English guy, lived in America for, all his working life, I think. Oh my gosh. Anyway, but Buffett has said it as well. And it's obvious. When you start your investment point from a high level of valuation, your projected 10-year returns are inevitably going to be lower than when you start from a low valuation metric. So again, doesn't mean the market cannot continue to go up. The thing about the US market in particular is that there are huge automatic passive inflows. A lot of it from 401ks. So you work for a company, you have a 401k plan, you allocate a little bit and the company puts in, some companies put in all of it, but companies will at least typically match what you put in, and normally more than that. And with those plans, you're given a menu every year, you're given a menu of choices as to where you want to invest in the year ahead. And my clients will send me these things and ask me, well, where do you think I should be? You know what I've got invested in my account with you. Where should I put this? And you look at those menus. There's no, most of them, it's US big cap, US growth. There might be one global fund, and there might be a cash or a bond fund. But there's no gold fund, no emerging market fund, no Asia, there's not a lot of choice. And so a lot of people just choose the S&P because it's going up, it's a place to make money, and they don't really have any of it anywhere else, so let's just put it in the S&P. That money's automatic. As long as the people are employed, it's automatic. Now, not only is it automatic, it's also, for the most part, passive. It gets reinvested into the S&P, and so the Magnificent Seven going up and outperforming becomes a self-fulfilling prophecy, or a self-fulfilling cycle, I should say. It's not a prophecy, it's a self-fulfilling cycle. And so when does that end? That ends, of course, when there's less automatic money going into the stock market, and that ends when unemployment starts to go up and there's fewer 401ks.
Thank you very much for that, Adrian. So moving to the sector where the risk and reward could be more favorable would be the commodity sector.
Yeah.
And I would like to start by talking about gold, Adrian. So gold performed quite well already. Of course, some people are not happy. They want higher prices. They want the 10,000 gold, which of course could happen in many years. But what are you seeing about the current prices, the money flow, the trends that are happening right now? Would you be still bullish, or maybe you could be patient for the next while because we could be a little bit overstretched?
Yeah, sure. No, I think I'm glad you asked me about gold separate from other commodities. We should look at the two separately, I think, at this particular point. So looking specifically at gold, so don't bury your lead. So my lead is I'm about as bullish on gold and gold stocks as I possibly could be. And in English terms, I think the second and third batsmen are at the crease. So for Americans that don't know what that means, I think it means we're close to, is it the second innings? I don't know, but we're early on in this bull market. Now, why do I say that after such a strong move? When you look at the last 3 years, when gold was, I don't have it, I think 3 years ago, gold was about 1,200, wasn't it? So we've had a very strong move in the gold price in the last 3 years. When you look at that, you look at why has who's been buying and why have they been buying? And we know that the number one buyer has been global central banks. Global central banks have been buying not because of economic factors, not because of inflation or low interest rates, not even because of directly or specifically because of fiscal deficits or anything else. They've been buying to diversify their reserves in the face of dollar weaponization, which has been going on for many years now. This is not something that started on January the 17th. So, and that's been going on for a long time. I mean, if you go back to the end of the last century, so 1999, the last century sounds so long ago, doesn't it? But it's only 1999. Global central banks in aggregate had something approaching 80% of their foreign reserves. Foreign means for a Swiss bank, not the Swiss franc, for the British Bank of England, not the British pound, etc. So global central banks had an aggregate of almost 80% of their foreign reserves in US dollar. Astonishing. 5 years ago, that was down to 65%. So that's a huge decline for institutions that are so slow moving as central banks. And of course, in the last 5 years, it's gone down. The latest number, at the end of last quarter was something like 47.5%. So it's come down dramatically. So again, this is not something new, but of course, it got, the spark was lit with the confiscation of Russian assets, rightly or wrongly, other people are saying, if I get on the wrong side for whatever reason, I get on the wrong side of the US, are my assets held in the US or held in Europe or denominated in dollars? Are they safe? And I think it's fair to say that nothing that Trump has done this year has diminished those concerns. But the concerns predated him again, just to make sure I don't get too many angry chats, comments. So anyway, central banks have been buying, and they've been buying for the reason I just said. Then you've had non-official Chinese people buying, concerned about the devaluation of yuan, concerned about the fragility of their banking system, so not wanting to put their savings into the bank, which would be a stupid thing to do anyway if you're concerned about your currency devaluing, not allowed to buy Bitcoin or crypto generally, and nervous about real estate, and rightly so nervous about real estate, because real estate has been a traditional place for Chinese savers to put their money. And so gold has been the obvious place for them to put their savings. So a huge spike in non-official Chinese saving this year. Again, nothing to do with the US and the US inflation and interest rates and so on. And then the last major source of buying has been wealthy Middle Easterners and Asians, particularly, but also Europeans to some extent, concerned about fiscal deficits around the world. Not just the US. The US, of course, with a reserve currency, their fiscal deficit matters more than other countries, but by no means is the US the only, or indeed only even the worst in terms of fiscal deficit. And so for all of these reasons, people have been buying gold. Where you haven't seen people buying gold are North American investors buying gold for what I'll call the traditional reasons that investors buy gold, which is a weak economy, thinking there's going to be monetary accommodation, low and declining interest rates, high and rising inflation. So you haven't seen that, and of course a weak dollar. So other than the dollar, which we just touched on, for the last 3 years, the economic environment has been exactly the opposite of what's normally conducive to gold investors, right? And so North American investors have really not been participating in this gold rally. When you add to that the fact that the S&P has been going up month after month after month, then even less is the interest in gold stocks. So if you look at North American investors, yes, you've seen some inflows into the GLD, which is the big physical gold ETF, but nothing that could be in any way described as a rush or a flood or a groundswell. And when I talk to friends who are coin dealers, for example, a friend of mine last month said to me, "Oh, we are so busy, the phone's ringing up the hook." Unfortunately, 75% of these people are calling us to sell, not to buy. Now, when you look at the GDX, for example, or the GDXJ, which are the two largest gold stock ETFs in the US, they are getting consistent, massive outflows. So the GDX this year is outflows of about $3.4 billion, which on 100 million, I think is 100 million. Let me just look on 100 million in assets for the GDX. That's, sorry, I need to check this. Sorry, way off. So it's a $16 billion in assets, and 3.4 billion has gone out this year. In the last month, they've lost over 100 million in outflows. My point is that US investors are not buying gold, and they are continuing to be heavy sellers of gold stocks. Now, when that changes, because this is the sort of the coup, if you like. When it changes, And it'll change when the economic circumstances shift in gold's favor. The economy is clearly slowing. The dollar continues to go down. Inflation picks up. Interest rates are cut. And for the gold stocks, when the S&P stumbles, corrects, doesn't have to crash, then you're going to see people start turning to other assets, and gold will be the primary beneficiary of that. Long answer, I'm sorry, but the point I'm making is we haven't even seen investors buying for normal investor reasons. So we're right at the beginning. And when you add to that, sorry, I must state this. When you look at the gold stocks, despite that they're up 60% year to date, which is astonishing, they are still undervalued. Now, how can I say that? Well, when the price of gold goes up, the NAV of the companies goes up, right? Because the ounces in the ground are worth more, and the mines, producing mines, are worth more. So the NAV has gone up. And so if the stock price stays the same, your price to NAV goes down significantly. So if the price of NAV is going up faster than the stock price, the stocks are actually less expensive today than they were a year and two ago. Same for cash flow. You've got incredible cash flows in those companies right now. And when the price of gold is going up so much faster than the costs of mining, your margins are expanding, your cash flows are growing, and your price to cash flow multiples, price to earnings, price to cash flow, price to free cash flow, they are actually lower than they were 2 or 3 years ago. So you look at a company like Agnico Eagle, the number 2 gold miner in the world, really good quality company, no particular hairs on that dog, as they say. There's nothing you can point at and say, oh, well, that's why they're cheap. And yet it's selling in its lowest 20 percentile of its price to cash flow in its history. You know, that they're really still very, very undervalued. But as Oscar Wilde, someone that an Irishman should know, Oscar Wilde talked about people who know the price of everything and the value of nothing. And I think that's what we're seeing now. You know, even if people are interested in gold stocks, they look at it and they say, oh, they're up 60% this year, I've missed it. But they haven't missed it at all.
Thank you very much, Adrian, for such a detailed answer. You already answered a lot of my future questions.
Sorry.
No, that's all good. So, as you mentioned, Adrian, so we have a lot of things that look very bullish for gold. And again, even at the current levels, the miners are printing cash. We had the Newmont mining releasing their numbers. They're doing really well. And now we're getting to the stage where the big guys, they are interested in acquiring these undervalued projects. It could be junior producers or developers. So I feel like soon enough, we could be getting to the stage where they will get interested in the junior companies or in the companies that do the drilling as well. So what's your take on that, Adrian? And is there a certain stage of the mining on the Lassonde curve that you could be more interested in right now at the current situation?
Okay, two good questions, or two interesting questions. I mean, we have started to see a pickup in, broadly speaking, M&A activity. And it's been of various types. I mean, Equinox and Cobre was one example, 2 mid-tiers getting together. We've had so we've had a lot of various activity, and I think we're definitely going to see more moving ahead. I'm not expecting 2 senior companies to merge. We had that, of course. The last one was Newmont and Newcrest. That was the last one, I think, of 2 senior companies merging. But I do think we could see more of the mid-tiers and intermediates getting together to build scale. We could certainly see more mid-tier development companies acquire specific projects, just as B2 acquired, well, they acquired all of Sabina, of course, but they acquired Sabina for one particular project. I think we're going to see more of that. So acquiring companies for one project or just acquiring a company. What's been a little bit slow, I think, is juniors being acquired. Although there has been activity in that space. And I think as investors, you know, we've got our 5 juniors that we think are takeover candidates. And if none of our 5 is taken over, we think there's no activity in the business. But in fact, you look at, for example, a company like Agnico that I just mentioned. Agnico historically has been one of the most active in partnering with exploration companies. They used to do it almost entirely through option earnings and joint ventures. More recently, they've decided to do it through taking equity stakes in companies, which means they don't have the, you know, they don't have the project, they don't have to work the project, they don't have obligations, work obligations, but with a, you know, 9.9 typically, with a 9.9 to avoid having to file, with a 10% ownership, it gives them a seat at the table. Not literally, I mean, they don't necessarily have board representation, but it gives them, as Amar Al-Joundi, the CEO of Agnico put it, it gives us an incentive and a reason to follow the companies closely. So, and they now have a portfolio, believe it or not, because of a rise in the gold stock prices of the prices of the stocks. They now have a portfolio of over $1 billion in exploration companies, which is astonishing. Now, he pointed out, this is not meant to be a hedge fund. This is not meant, we didn't buy these things to make a profit. We bought these things because of particular projects that we were interested in. So I think you're going to see some activity in that. I think as a long-term value investor, my approach is to buy quality companies that I intend to hold for 3 to 5 years minimum. And I tend not to buy companies. I certainly never buy companies just because I think they're going to get taken over. Now, if I'm looking at 2 companies that are both of equal quality, equal this, that, and the other, and one is a potential takeover and one's not, I might bias my buying towards the one that is. But I tend not to buy things that are just because they're takeover possibilities. And the reason for that is that even where something is fairly obvious, oh, you know, company X just has to buy company Y, because after all, company Y's project is right next door to their existing mine that they're developing. Well, yes, but those things can take a long time to come to fruition. And you can see gold cycles. I know people, but it's happened to me. You buy a stock at $1 thinking it's got to be taken over. The stock falls to 50 cents. It gets taken over at 70. Everybody calls it a win. And I'm sitting there saying, well, I just lost 30% and I was right. So, you know, if you think about it, a company that's building a mine, they're putting a lot of time, effort, and money into developing a particular project. The last thing they want to do, the last thing they're thinking about is buying the asset next door to expand their assets just because the stock price is cheap at this particular moment. They would rather get their mine up and running, have it producing for 1 or 2 years, prove that it's working, that there's no mineralogy problems they didn't know about, that the veins run, et cetera, and then when everything's up and running, say, well, why don't we add some ounces to our reserves? And that could be 5 years before they do that. Agnico, again, I mean, I can't tell you the number of companies that have pitched me on their stock, and there's always a nod and a wink. You know, Agnico's going to take us over, you know that. I mean, if Agnico bought every company that people think Agnico's going to buy, well, they don't have the money to do it. Let's just put it that way. And again, a company like Agnico's got enough on their plate at the moment. They're not necessarily looking. They don't need to buy additional ounces and additional companies and additional projects. So in terms of the Lassonde curve, so we manage a fund, Peter Schiff's gold fund, and I also manage separately managed accounts. Excuse me. So my approach is a little bit different to each, because with a fund, you have a lot of restrictions on the amount of smaller stocks that you can own, and you have to be fully invested, and you also get, you know, you have a possibility of large inflows and large redemptions, so you have to be liquid. So in the fund, we would tend to look more at that second stage of the second buying opportunity in the Lassonde curve as they're getting development underway. So that it's a project that we can then hold for a long time, but a lot of the risk is taken out of it. For separately managed accounts, we would look at both. Now, I'm not so what I'm about to say is not necessarily advice that everyone should follow. I'm not a geologist. So even though I've obviously learned a lot about geology over the years, I'm still not a geologist. I'm still not an expert. I have no edge in looking at a project from a geologic point of view. I have no edge over people that are extremely skilled at that. And so I will tend not to buy companies in the very early stage based on good geology with a view that just 1 or 2 or 3 drill holes will get me a 5-bagger. Because again, I don't have those skills. Where I have some skills, I tend to look at companies as companies. So I want a company with good management. Good means a lot of different things, but one of the things it means is that they've been successful in the past. I want good management. I want a company either with cash or with ready access to cash if they need it. Now, that might mean a line of credit. Some juniors have lines of credit. And of course, if you're a junior, your line of credit can be very expensive. But at least you have a line of credit if you need it and the market's weak. It might simply mean that you have 1 or 2 key shareholders that will support the company. So you mentioned Lassonde. If you see Pierre Lassonde or Trinity, which is his investment company, if you see them as a large shareholder in a company, doesn't mean it's going to be successful. But what it does mean is that if they need money for something valid, like for drilling or something, they can always get the money from Pierre. I mean, it'll be on commercial terms, but they can get it. Same if you see Ross Beatty as a shareholder in a company. So people like that, they're obviously wealthy, but they've been very successful. But they're always ready to support the companies in which they're investors. So anyway, a company with good management and either capital, either cash or access to cash, those things are important to me. And then lastly, I'm looking for a business plan. I'm looking for a good strategy, well executed. I'm not looking for a particular ground with a particular and the next drill hole. That's just not my style. And good luck to people who do that, but it's just not my style.
Thank you very much, Adrian. That's a very detailed answer again. So Adrian, I'm personally a big fan of these small mobile royalty companies like Vox Royalty, EMX. We have Orogen Royalties getting deal now with a triple flag as well. And I think these sort of companies, they align pretty much everything you have said. They have a lot of projects. They have usually strong management. etc. So what's your view on this niche, I suppose, of small royalty companies?
No, I'm a huge fan of the smaller royalty companies. As you know, once you get beyond, let's call them the big five, although there's a triple flag of Cisco and then Royal, Wheaton, and Franco. There's a huge difference between triple flag and Franco, but call those the big five. Now the sandstorm's out of the equation. You drop very, very quickly to companies that are sub 400 and sub 300 market cap US. And there's a lot of companies that are down at the 100 million, 150 million space. Now, I'm a big fan of the junior royalties. There are a couple of issues that they have. I'm not someone who thinks big is better, but in the royalty space, bigger really is better, or at least it gives you a big advantage, because when you're a 100 million market cap company with one producing royalty, your cost of capital is going to be very, very high, which means you really can't compete with the 300 and 400 million market cap that has access to a line of credit and has revenue from 4 or 5 different companies. You simply can't compete with them because their cost of capital is so much cheaper than yours. So you have to have some kind of niche. You have to have some kind of relationship that allows you to see royalties, such as Empress does, allows you to see royalties before they're auctioned or shown to everybody else. But I like the space. But you have to recognize that having access to capital is important. Metalla, for example, and we are a large shareholder of Metalla, but Metalla for many, many years had convertible issue from BD Capital and a line of credit with BD Capital. Now, the truth is it was an expensive line of credit. But BD was a supporter. They were always there for a good deal. They were always there, which is what you want with a supportive shareholder. And they own, they did own something like 9% or 12% of the shares. So big shareholder, as well as a line of credit. Now, just recently, Metalla exercised the convertible shares and canceled the line of credit by getting a traditional bank line of credit with BMO and National Bank. Lot less expensive, and also a lot larger line of credit, and that enabled them to pay up line of credit. So anyway, I'm going into that because you need to look at that. But in order to grow, so it was an expensive line of credit with BD, but they could not have grown without it, right? Or they couldn't have grown as rapidly as they have grown. And so having that access to capital is just either having access to capital or having your own feeder source for royalties is critical. Again, size not only gets you a lower cost of capital, but it also diversifies your portfolio, because now you don't have just one royalty, but you have 2 and 3 and 4. And as we have seen, even though royalty is a low risk business model, if something goes wrong at the mine, Cobre Panama, for example, it affects your revenue. So you looked at the hit that Franco took when Cobre was shut down, and that was 19% of their revenue. Franco's a 25 billion, whatever it is, market cap company. So as a company, they could stand it. But can you imagine if you're 100 or 200 million market cap company and you only have one source of revenue and it gets shut down? It's a blow to the company, a staggering blow to the company. So anyway, those are the things I look for: diversified base of revenue, but also access to capital is critical.
Thanks, Adrian. And just to mention silver, would you be as bullish on silver and silver miners as you would be on gold?
Well, I would say probably not. In terms of a physical, right now, I mean, I just think gold has better risk reward than silver. That's not to say I'm negative or bearish on silver at all. I just think the risk reward is better. When it comes to the silver stocks, as you know, as we all know, there are very, very few silver stocks, whether producers or explorers, that are pure silver. You know, most of them are gold and silver and base metals. So even if you look at a company like Pan American Silver, silver's in its name. It's the second largest producer of silver in the world. And yet last year, only something like 17% of their revenue came from silver, which is less silver than you get from Royal Gold or from Wheaton, less silver exposure than you get from, two of the big royalty companies. Nonetheless, because silver's in their name, and of course they do have two very, very large silver projects that are sort of options for them. One is the Escobal in Guatemala that was shut down under previous management, and one is Navidad in Argentina, which is an exploration project that they need a permit for. But anyway, they do have that optionality, of course. But when silver moves, the price of Pan American Silver moves. My goodness, even the price of Fortuna, which used to be Fortuna Silver, but it's now Fortuna Mining, with a very small percent of their revenue from, actually about the same as Pan American from silver, that moves as well. So I guess what I'm saying is because there are so few pure silver companies, when the price of silver moves dramatically, the price of these sort of hybrids, if you want, will also move. And so I prefer, rather than saying I'm going to look for a pure silver miner, I'm going to look for a pure silver exploration company, I will look for my silver exposure inside other companies. It might be Pan American. And I should say that the ratio, Pan American's percentage of silver revenue will be higher this year now that they bought the Max Silver. And also potentially will be meaningfully higher going forward. I should point that out. But I prefer to get my silver exposure inside of Pan American or Wheaton even, 39%, 38% of their revenue from silver. So you're getting a lot of silver exposure in those companies.
That makes sense. So just before we wrap up, Adrian, I like to ask this question for the younger audience. So if we have an individual who is still at the beginning of their wealth building path, and they have so many choices, they have the Bitcoins, the Nvidias, the things that we're discussing right now, what advice, Adrian, would you have for that individual on how they could start their wealth building path and what they could pay attention to during this part of their life?
Yeah, I think the most important piece of advice I would give would mimic what Buffett said, or what his partner, I think Munger, said. First rule of investing is don't lose money. Second rule of investing is don't forget the first one. And the irony is that when you're younger, you think you can take more risk, and you can afford to take more risk. But if you buy relatively conservative companies that will grow and compound over long periods of time with relatively little risk, I mean, all stocks have risk, but relatively little risk, you will, in all likelihood, at the end of 10 years, okay, so you won't be wealthier at the end of 1 year than the guy who's speculating on crypto and meme stocks and everything else. But at the end of 10 years, the likelihood is you will have built a meaningful amount of money just from being conservative and not losing money along the way. So that is the advice I would give. Now, I can tell you what I think would be suitable components for a portfolio like that. I mean, I like some in the school of business development companies. The largest one is one called Ares Capital. It yields about 9.5%, fully covered by earnings. And that's the sort of thing that you would tell your grandmother to buy. But if you're 22 years old and that thing is earning 9% a year, year after year after year after year, and their earnings are growing, meaning the stock price over 5 and 10 years should also appreciate, you're going to do pretty well. But of course, when you're 22-year-old, you're not thinking of how much money you're going to have when you're 32 or 42. You're thinking of how much money am I going to have next week? But that's the best advice I could give, to be honest. When I look back, when I look back and think of the amount of money that I simply lost by investing in large amounts of money, large for me at the time, whenever that time was, large amounts in things that I really didn't understand, but seemed to have that 5 or 10 to 1 potential. The get rich quick mentality is what kills you.
That's a great advice. Thank you, Adrian. So, Adrian, that's all the questions I had. Again, thank you very much for being here, and I hope to have you back, sir.
Well, I appreciate it very much, and nice meeting you.